Hello, and welcome to HWM Investment. This analysis is for Howmet Aerospace on the New York Stock Exchange as of 4th of August, 2026, with a share price of $290. The full report is on HWM.ca. At $290.10, Howmet is an elite aerospace compounder, near sole source, flight critical engine parts, quality 82, a strong driver at 76. But it trades approximately 67 times earnings against the approximately 22 times warranted multiple 3.03 times deep in the expensive band, and its Q2 print lands 6 August 2 days out. Hold on every horizon, great business, rich price. Howmet Aerospace, built from the former Arconic, makes highly engineered metal components for aerospace and transport. It runs 4 businesses: engine products, the turbine airfoils and rings inside jet engines, aerospace fastening systems, engineered titanium structures and forgings, and forged aluminium truck wheels. What sets it apart is a near sole source position on flight critical, spec certified castings and forgings that are extraordinarily hard to qualify a second supplier for, which gives durable pricing power and a rich recurring engine spares stream. Think of it as a high moat picks and shovels supplier levered to the commercial aerospace upcycle and defense. Quality scores 82, the driver 76, and first quarter revenue grew 19% with earnings up 71%. The valuation is where an excellent business becomes only a hold, and here it is extreme and got worse. Howmet trades near 67 times trailing earnings against a warranted multiple of about 22, a ratio of 3.03 times deep in the expensive band. That is wider than July's 2.73 because the 10-year yield rising to 4.75% trimmed the multiple we can justify. The valuation pillar scores just 36. At today's price, the market embeds around 25% sustained 5-year earnings growth. Our disciplined estimate is 10 to 15, and the room to consensus has compressed. The analyst target of 299 is now only about 3% above the price. The growth is more than priced. To be clear, this is a hold on the price, not the franchise. The balance sheet is sound, net debt to earnings under 1 times, interest cover over 15, and the aerospace upcycle is genuine. But at 67 times, the stock is priced for a flawless, multi-year supercycle on a fresh all-time high with a monthly relative strength index near 81. On top of that, Q2 earnings land on the 6th of August, 2 days out and inside our 7-day blackout, an earnings event caution that would cap any buy regardless. The signal is already hold, so nothing changes, but it is the wrong moment to reach for a rich stock. The honest move is patience. Own the quality only if a better entry appears. Balance is the point of a hold, so take both sides. On the upside, the bull case is $350, about 21% above today, if the aero upcycle and aftermarket richness keep compounding and the premium multiple holds, and an existing holder is under no obligation to sell a quality compounder. But the downside dominates from here. The bear case is $235, roughly 19% below the price, where a growth scare, an aero build rate stumble, or rates staying higher for longer re-rate the stock from 67 times toward 40, from a ratio of 3 times warranted on a fresh high. That mean reversion is a real move, not a wobble, which is exactly why a fresh buyer waits. Now weigh the risk against the reward. The bull case is roughly 21% above today, the base case, the most likely, about 7%, and the bear case a fall of about 19%. So you are risking about 19 to make 21. So, our call on Howmet Aerospace on the New York Stock Exchange, hold. Remember, this is for education, not financial advice. Always do your own research. This analysis is by HWM Investment at HWM.ca. The link to the full report is in the notes below. Have a great day.